Hi, this is Jim Welsh from Macrotides.com. Thanks for tuning in. Well, last August, as gold was zooming over $1,500 an ounce, just about every strategist and analyst that came on CNBC was bullish, and I took that as a contrarian sign. As I noticed in my August 26 weekly technical review, in November of 2018, there were only 10% of traders who were bullish gold, but by August, that had risen to above 90%. And given what was going on in the positioning within the gold futures, I thought gold was flashing a bright yellow caution sign. So let's take a look at position in the gold market to see what clues and insight we can draw from that. The panel I want you to look at is the middle panel. The green line is the large speculators who are typically trend followers. And if you look back to mid-2016, you can see that the green line representing the large specs had amassed a very, very large long position based on the big rally that had preceded in the prior months. Now look fast forward to where the positioning was in July and August, and you can see that the positioning in gold by large speculators was equally if you will, stretched and bullish. What that suggested to me was that gold was vulnerable to a pullback, and if one developed, those who were long would gradually be forced to liquidate. What followed the July 2016 high, gold dropped from above 1350 to under 1150 in less than 5 months. So to me, that indicated that gold was vulnerable to a fairly decent size decline. If we look at gold, it rallied from 1266 to 1556, so a rally of $290. A 50% retracement, which is fairly common, would bring gold down to 1411 from that 1556 high, while 618% retracement targets 1377. Given the high positioning that remains in gold by large speculators, I think the outlook must be respected that gold could in fact drop to that 1377 target. In addition, the July 2016 high of 1375 and January of 2018 high at 1365 would be a place that one would anticipate support coming in. So gold has the potential of falling an additional chunk in coming weeks and months. In the October 14 weekly technical review this past Monday, I looked at the gold stocks and indicated that they were vulnerable to a meaningful pullback. GDX had fallen to 2650 on 4 separate occasions, but what we can see is the last 2 rebounds have been weaker, meaning that GDX made a lower high. This suggested that it was getting less support from that 2650 and was vulnerable to a decline below 2650, which is happening on October 15. Targets, the 50% retracement of the big rally in GDX, suggested it could drop to 2555, while the 618 retracement targets 2428. And if you can see, back on June 19th, there's a gap at 2403. So GDX has the potential to have a meaningful decline from here. Potentially, though, it could be even a deeper decline based on the head and shoulders top that is formed in GDX. As you can see, on the left side and right side, there are 2 shoulders on both sides, which are remarkably proportional. The neckline to the top is anywhere from $4 to almost $4.50 and suggests that GDX could drop to somewhere between $22 and $23 a share. So this implies that if you're long gold, you may have some pain in coming weeks, and the next buying opportunity won't come until we see more price damage. Thanks for tuning in. May something good happen to you today.